Hey, if you're looking to invest with a purpose, this is a conversation you want to check out. I sit down with David Bacon over at Worthy Wealth, and he shares how they're investing in senior living facilities while also offering really accessible investment opportunities. You can get into some of his deals for as little as $10 or $100. If you want to learn how to invest with less upfront capital, make sure you check out this conversation right here on Multifamily Insights. David Bacon has a background in digital marketing, investor acquisition, and growth strategy with a focus on alternative investments and expanding access to real estate-backed opportunities. Now, currently works in education and connecting everyday investors to income-generating real estate strategies, including senior living and other demographic-driven sectors. Let's welcome to the show, David Bacon.
Great to be here, John.
Absolutely, David. Great to have you. I went over your background at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, I started actually doing marketing in another lifetime, it seems like right now, but um, my career has taken me through a lot of different verticals, and I ended up at in finance in a couple of those. But what made my decision to come to Worthy Wealth pretty interesting was the fact that this is a company that offers investment opportunities that have a secondary benefit of being very, very good and impactful on a social cause, or it aligns with somebody's values. So there's kind of two returns there. You get an attractive return, but you also feel great knowing that your investment dollars are going to help somebody else.
Yeah, you talk about the monetary return, right, on your own goals, as well as the social impact return and making a difference in other people. We know that's big for a lot of folks, especially some of our younger investors. Why is that important to you guys over at Worthy Wealth?
The Jobs Act in 2012 made it so that really anyone could make an investment in an investment opportunity that was normally reserved for wealthier accredited investors. And in this case, that's what Worthy Wealth does. We offer senior living shares, housing bonds. Each of these shares or bonds are only $10 each. Uh, with senior living, we have a minimum purchase of $100 your very first time. But most anybody can afford $10 to get a new share in a real estate backed security. And this allows us to really expand the amount of accessibility into this type of investing.
So, one, I appreciate you sharing that, right? You talking about the democratization of investing, particularly when it comes to real estate backed investment opportunities and being able to get into some of these deals for as little as $10, right? Like, that's kind of insane. I mean, the world we play in is multifamily syndications, and typically our minimum investment is $25,000 or $50,000. So this is a very different approach than what many of our listeners are used to. I'm just curious, like, how are you able to make offerings with such low entry points?
Volume, number one. You can, I guess our philosophy has always been we'd rather have 1,000 investors at $10 each than one investor at 10,000. And it's good for a number of different reasons. But as you scale that up, we find that we find that people make investments when they can. They do recurring and automated investments. They even do rounding up on everyday purchases to help with their investments. So the amount of funding that we get comes from a larger group of people, and it comes in smaller increments, but it still adds up to meaningful funds that we can target towards some of these investment opportunities, some of these areas where we find bottlenecks in demand.
So we're going to talk about the kind of assets you're investing in momentarily. I want to come back to this concept of, you know, offering kind of a lower entry point to more people. You said you'd rather have a thousand people at $10 instead of one person at 10,000. So part of that is it makes it easier, right, to raise capital because you're not relying on one person to be a huge check writer. You're really getting out there and getting to the masses. So it's a little bit easier to do that. And we see that in the stock market, right? That's how stocks work for the most part. When it comes to this space, though, I guess, what are some of the pros and cons with that approach? Because I imagine, if someone's investing $10, I don't know how how much conversation you're having, your team's having with them about the investment or getting deep into the investing strategy and the exit strategy and all of that, right? So, what does that actually look like, and what are some of the pros and cons with your model?
Yeah, good question. And we always tend to start at talking about $10. Our investors typically put quite a bit more into that, although the
$12.
option, yeah,
No, I'm messing
$12.
with
That's right,
you.
20% more.
Yeah.
Um, but I think one way to look at it is any type of real estate investment, a traditional real estate investment, typically focuses on one building or one asset. And with that one building or one asset, you localize your risk. So, for example, let's say a contractor walks out. Let's say the insurance rates decide to change locally, or there's something that goes on in that area legislatively, for example, that affects the value of that. That risk is right there. That's all you have. The way that we look at it is we take investor money and we pool it into a portfolio of real estate backed investments. So, in the case of senior living, where we target a 15% annualized return, it's a portfolio of senior living facilities. If we have a problem with one, it doesn't affect the rest of the portfolio. Same with our housing bonds.
That makes a lot of sense, right? So you have that portfolio approach where it's spread out. It kind of ties in with your other comment, right, on that lower threshold, because it's really about, minimizing risk because you're not centralizing either the investment or the asset. You're spreading it out, right? You're spreading out the number of investors you have, how much they're investing, the assets they're investing in. So there's diversification throughout everything that you're doing, which allows you to really minimize or spread risk. So, one project, one investor can't really derail the entire portfolio. And there's a lot of logic and a lot of great benefits in taking that approach. So you mentioned, I know we harped on the $10. Most of your investors are not in doing $10, right? They're investing more than that. Who is kind of your ideal? Well, let's say it two ways. Who's your ideal? And when I say ideal, what I really mean is your typical. Like when you look at your investing profile, who is the typical investor? What are they investing for? What's their time frame for investing? What is their occupation? Let's just start there. Like, what does that typical investor look like for you guys?
Yeah, sure. Our sweet spot with investors are, quite frankly, the millennials. Um, right there in that demographic, they're at a point in their lives where um, they're either in the middle of having families or kind of starting to get towards the end of that and are looking for financial independence or financial security a little bit later in their lives. And they're looking for a little bit higher return and they're looking for an alternative investments, which is what we are. But the nature of all of our products lends itself to all age groups, obviously because of the price point that we have, but also with the incrementality of it. So on the low end, we see a lot of Zennials. We see a lot of younger people that are starting to use their phones and apps to do quite a bit of investing early. Yeah, when I was 22 years old, I didn't have a dime in an investment. And yet both of my kids already have retirement accounts just because it's easy to do and they can do it on their phones. But think about somebody, again, on the low end, think about somebody who's got as an hourly employee or somebody that is a gig worker or somebody that does not have a consistent income. The way that our investments are set up is that anybody can invest and they can do it in a way that's best for them. And on the other side, we have higher end investors that understand that senior living, for example, is backed by an inelastic and surging demand in an aging population and are looking at why the supply is not rushing to meet that demand. So they see the benefit of looking at I can say the certainty of an aging population against why the supply is not rushing out to meet it. That's what we are investing in at this point.
So that more experienced investor, they recognize the opportunity. They see the imbalance of supply and demand when it comes to senior housing. So that's what's attracting them. And maybe that younger investor that you called them a zennial. Is that what you referred to them
Yeah,
as?
Gen Z, millennial,
Man,
kind of that.
you're definitely a marketer with those terms, man. I'm a
Yeah,
marketer too, so I spend so much time just get into those demographics and psychographics and all that good stuff, man. But I mean, the point you're making is, there's that the gap between Gen Z, or kind of that crossover between Gen Z and millennials,
yeah,
where they're using technology, and some of them are working the gig economy. They don't have your traditional W-2 jobs. They're not working 40 hours a week in one company. So the 401k, your traditional retirement plans, like it just doesn't make sense for them. Sometimes they're just not even available to them. So they're finding different ways to invest for their future. And this is one of those platforms that gives them an option where they can come in and invest. When it comes to multifamily syndication, and I'm using that because that's what, this show is primarily, anchored in, is multifamily investing, in particular in syndication. So a lot of our listeners are familiar with how syndications work. There are a couple things, right? So one, and I've been doing syndications for over a decade. So you're not going to hear me say much negative about, close to a decade, but you're not going to hear me say much negative. But there are drawbacks, right? One of the cons is, the time frame. Typically you're looking at 3 to 7 years on those deals. Usually the minimum investment is around $50,000. Sometimes it can be 25. Sometimes it can be 100. So you're looking at that, and then it is a single asset, right? It's a single deal, it's a single property where you are looking at that operator to be able to go out there and execute. With what you're talking about, lower minimums. You talked about, we didn't get to the time frame, so I want to hear you talk about the time frame. At what point can an investor exit a deal, and then what are, I don't want to say advantages, but like what are some of the other differences when it relates to more of a traditional multifamily syndication investment?
yeah, absolutely. So, we already talked a little bit about the fact that you're spreading your risk around a portfolio of properties. Um, but let's start with the returns, and let's start with fees and things that you would typically associate with a more traditional multifamily investment. So, in our case, because we are a lower threshold, we are not charging any fees whatsoever. So, if you put $100 into this, if you put $10,000 into this, all of your money is going into the investment portfolio because we make our money on the back end of the investment. So the way that, for example, senior living works is you will invest a minimum of $100 or as much as you like. Um, and all of that money goes towards the investment. Typically, in a traditional real estate investment, you'd have some cash drag. You put your money in, it sits, doesn't do anything until the sale happens. With with us, it's a little bit different. So obviously, we're accessible. When you put your money in, you will earn a 5 to 7% quarterly dividend until the property or properties are sold, which we ask our investors to give us between 2 and 5 years. So in that period of time, your cash is still making money. When the property is sold, we take 60% of the profits that we make and we distribute it among our shareholders. So in this case, we're targeting a 15% annualized return, which includes both the dividends that you would get on a quarterly basis, plus 60% of the profits that are distributed among our shareholders.
Yeah, so you're saying that back, right? Make sure I understood. So you're giving a 5 to 7, or you're offering a 5 to 7% return to investors quarterly. And on top of that, once you sell the asset, there is a 60% distribution to those investors in that deal. So it's almost like a pref return situation, right? Where you got that 5 to 7% pref, and then on the back end, they're getting 60% of the equity generated from the sale of that asset, right?
Yeah, it's a
Um,
preferred share.
there you go. So, but you guys are doing that with much lower minimum. Are you doing that as like a Reg A offering, or what's the structure for the actual deal?
That's a Reg D offering.
That's a
And
Reg
we do
D
offer a Reg
offering.
A, Tier 2 Reg A offer with our housing bonds, but this particular one we're talking about is Reg D.
Got it. Okay, so that's Reg D. So with that one, for those that aren't as familiar, maybe you can quickly explain what Reg D is and maybe some of the limitations there, or just a little bit of how they work. That works.
I actually don't know.
Okay, so I'll fill in some of that, right? So we've got Reg A and Reg D are basically the two SEC vehicles that allow you to raise capital from investors and take on money as a security and then make those distributions. So the reason I was asking the question is typically with Reg D you have a 506 B offering, 506 C offering, B as in boy, C as in Charlie, and through those there are there's some limitations of how you can raise the capital, and because of that it creates limitations of how many either non-accredited or sophisticated investors you can take, which is why most investors can't do it for a very large raise. So let's just say you're raising $10 million. It's almost it's very challenging to do that with 506B Reg D offering, right? Because you're only limited to 35 non-accredited investors, so it's harder to do that, especially if your minimums are lower, which is why people have higher minimums, and there's a whole thing there. With 506C, you eliminate the ability for some of those unaccredited investors to invest. So that kind of goes against what you're talking about, which is the democratization, which we love. And it's always been this catch-22 situation for us because we want to make it where we can bring more investors in. But the SEC actually makes it almost punitive if you bring in folks who don't thoroughly understand investing risk and challenges, which is why we do a lot of education. But it can be tricky for folks. So the other option is more of a Reg A that I'm aware of, at least, where it's more of a fund model. And because it's more of a fund model, they can come in and invest $100, $1,000, whatever it is, and they're not necessarily investing in that deal specifically, but they're investing as a whole into the fund and the model, which I think what you were talking about as far as being able to, I'm not going to say cross collateralize, but to spread the investments across different assets. That's kind of what the way you were describing, that's what I assumed or thought it was, which maybe it is, maybe it's not. But I think it's important for folks to just understand how it works, because obviously we're talking about, how things work when things are great. Obviously, there's some different challenges if things don't go great. So it's a matter of really just understanding the investments. We're not attorneys ourselves. I've talked to a lot of attorneys. It doesn't make me an attorney. I did sleep at a La Quinta Inn. No, I'm kidding. But I think it's a Holiday Inn anyway. Wrong commercials. But the point here is understand this, right? Whenever you're looking at investment opportunities, you want to understand how this deal is structured. Is it a 506B? Is it a 506C offering? Where do you sit in the capital stack? All that means is who else is in the deal and who gets paid first, right? Typically, your bank's going to get paid first. Then you may have some sort of, mezzanine debt or a JV partner position or someone like that. And then maybe it's going to be your limited partner or your passive investors, and it might be your either JV partners or your GP partners. So either way, the point here is whenever you're making these investments, you definitely want to understand how the investment works, even if you don't, love that part of it. I think it's important to educate yourself. Okay. Understand how the deal works, understand who gets paid first and where the risks are in the deal. All right. David, unless you have a comment on that, I want to transition, talk more about the kind of projects you guys are working on today.
Yeah, and the only comment I would make on that is really with the Reg D and the Reg A offerings that we become the bank. Our investors become the bank. So with preferred shares, for example, with our senior living product, because you are the bank, you have priority when those investments come in. So
Yeah.
kind of
Do you
simple.
guys work with lenders, or to your point, are you using your private capital to do 100% of the funding?
No, we have partners that we work
Okay.
with.
Okay.
So that way we can also pool our resources
Yep.
with larger resources and make these purchases.
Makes sense. Okay. So we talked a little bit or kind of alluded to senior housing, right? This has been, I don't even want to call it a trend, right? But this is just where the data has been going for quite some time now, probably at least 10 years. I remember I did an interview Man, it was probably 8 or 9 years ago, and I remember hearing the term the gray tsunami or silver tsunami for the first time. And the point was, we were having 10,000 people turn 65 every day in this country, the United States of America. And there's so many people who need senior housing and different levels of care, and we just can't keep pace from a building and a construction standpoint. So that demand continues to grow. This is one of the areas I know you and your team play in. Talk to us about where you see the opportunities. And, again, senior housing and senior facilities is kind of a broad term. So talk to us about what you guys are actually investing in today.
Yeah, John, it's hard to overstate the nature of this market right now. Like you said, 10,000, actually more than 11,000 at this point, baby boomers turn 65 every day. In the next 20 years, we will have increased or double the number of seniors of age 80 or higher, meaning then that's the prime age when they're looking for assistance in just daily life type of thing. In addition to that, the occupancy rate for current senior living facilities is at 90%, and it's been growing for 19 straight quarters. So, as you paint this picture of the demand, Silver Tsunami is very accurate. It's inelastic, it's surging, uh, and you really can't buy your way out of aging. So, that part of the equation is a certainty at this point. So, going back to what I was saying before, why don't we have so many developers rushing in to meet the demand here? Because we're going to need, as a nation, we're going to need $1 trillion in the next decade just to build enough to meet the demand we're going to have. And construction right now, and this is on the other side, um, new construction right now is at a 2 decade low. In addition to that, 50% of the cities in the United States have no senior living facility construction going on right now. So clearly, there's something between the demand and the supply that's causing this bottleneck. And it really boils down to the financing of the dirt work, the horizontal work. I'm sure your listeners know a lot about this. If they don't, vertical construction is anything with a roof on it, and banks will lend to vertical construction without any issue. But the horizontal work, which is the water, the power, the sewage, the dirt work, um, banks will charge 50 to 100% higher interest rates on those loans than they will for vertical construction, which translates into a 12 to 18% premium rate on that type of work because banks consider it more speculative. So all of a sudden, you've got demand, you've got people that want to meet it with the supply, and they can't because they can't get in there and build new facilities, um, at least ones that are going to be affordable to the general senior citizen out there, the normal senior citizen out there. So what Worthy Wealth has done is we've looked at it and said, okay, of the senior living facilities that currently exist in this country, 40% of them were built before the invention of the smartphone, and they are functionally obsolete. So, and this is not a great image, but it will paint a pretty vivid picture. Think about a nursing home from the 90s. You may have gone in at some point in your life, and you look at them almost like a hospital. It's a long hallway with all of these rooms on it. It's all very clinical. It's very sterile, um, and not a fun place to be for seniors, or it's just not a welcoming place. Examples of that or excuse me, an example of what you might find in one of those types of functionally obsolete facilities might be a common bathroom down the hall. You might find kitchens that are located on one far side of the facility, and food is dropped off by room. And unfortunately, if you happen to be last on that chain, you may have you may not have the best you may not have that hot meal that you had been hoping for. Seniors today are demanding something very, very different. They are demanding, I don't want to say a resort, but they want a community. They don't want to spend um, these years of their lives being confined to a single room. They want studio and single bedroom apartments with their own bathrooms. They want multiple places where they can meet new people, participate in personal wellness services. They have access to a gym, connectivity. Um, these are just fundamental things that our seniors demand right now. And 40% of our current senior living facilities out there simply don't have it. So our approach to this is, instead of looking at exorbitant interest rates to go break ground on new facilities, we purchase those functionally obsolete facilities at a pretty steep discount. We put the money in to modernize it, upgrade, bring it up to 2026, 2027 standards. And then once that's done, we turn it over to a professional team to manage. We sell the property, and that's where we make the appreciative income that we give back to our shareholders.
David, I love what you broke down there for a couple of reasons. First of all, just illustrating what seniors are looking for. We kind of joked earlier, but this is where the marketing background really comes into play, right? It's really understanding, recognizing trends, demands, and finding the gap. And this is just being an entrepreneur in general, but from a marketing standpoint, what you guys have done is you've taken a look and said, okay, we know the data says we have a lot of aging family, people in this country, right? On top of that, we're not able to build enough quality senior housing for these individuals. And mainly is due to the loans that are available, since most banks see it as speculative. So you found a solution, which was take these functionally obsolete properties, invest in them, retrofit them, remodel them, and modernize them. And now you have found a way to bring this thing whole, where it's attractive for the folks who are looking to stay there. And then you can exit from there. So you kind of have a value add senior living facility strategy where you are buying existing structures, but you're renovating them so that they can be the right project or the right amenities for today's resident. So I love that model and that approach that you're taking, which is very similar to anyone else, right? And I think oftentimes, and we get caught up in some of our terminology, but value add is really just a fancy way of being able to identify an opportunity to create value as an investor. And if you're investing in real estate, you are a value add investor. Part of that may be we're going to hold this long term because we think the area is going to improve organically over time. It could be you're going to renovate, certain parts of the property. It could be you're going to reposition the property. Maybe you're taking other facilities and you're converting them to a certain type of asset. So I love the way that you're thinking about it creatively, the way you and your team are approaching it, and finding that opportunity in the marketplace. However, it does beg the question, if there is such a demand, it's such a growing need, is there enough functionally obsolete properties to do this? It seems to me that when you have demand the way you're saying it, right, 90% of them are occupied, it seems to me that there wouldn't even be enough properties that are, existing today to go out there and retrofit them because the demand is so strong and people are just having to accept whatever exists.
Yeah, not nearly enough. But this is the area that we're working in right now. And obviously the benefit there is that if you're not breaking ground on new facilities, and yet we're over here modernizing them in a much shorter amount of time, then we're creating that inventory a lot sooner than you would had you had to start from scratch. In addition to that, we're taking something that is not subject to those extraordinarily high dirt work interest rates and allows us to offer more affordable senior housing once we're done modernizing the functionally obsolete ones. So we talked about the value add, and this is really where we really thrive, and that is the attractive interest rate, the no fees, but also at the end of the day, you're building, or we're creating places that people are very comfortable looking at their parents going to, as opposed to what was available before. So feel good about the investment and still earn a great return. That's an area that we love to play in.
And I love it because, I mean, as real estate investors, that's ultimately what I know many of us want to do, right? We want to create beautiful spaces, homes, facilities
Mhm.
for people to enjoy. I mean, yes, we want to make money. Of course, that's part of the process, but we also want to be proud of our investments. Knowing that we make a difference in other people's lives is something that many of us can get behind. So I appreciate you sharing that. For folks that want to learn more, David, what is the best way for them to reach out?
Yeah, just visit us at worthywealth.com, and you can take a look at all of our offerings and find out a little bit more about how you can invest.
All right, David, we're going to transition and go to our round of insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide, go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you though, we've put a link in our show notes. So you go to our show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Give me a failure or an apparent failure that sets you up for later success.
A failure or apparent failure. How much time do you have? Honestly, I can tell you that, when I was first starting out, coming out of college, I got a job as a manager, managing a team of people, and ended up just being a really, really poor manager. I had the wrong attitude going in. I was a lead from behind, send off people and let them do my work. And it wasn't too long before I realized that my success rests on the shoulders of those who I represent and who I manage. And it was a tough lesson. It will hit you in the ego occasionally, but today that's completely different. My management style today and kind of the way I approach just general relationships is to have a very firm understanding of what the other person is doing or what they're motivated by, and try to work so that there's a collective and an intentional cooperation to get there. And it's really served me well.
Appreciate you sharing that. Give me a digital or mobile resource you recommend for our listeners.
Well, I don't want to do the fallback today, but AI is absolutely, if you're not already ensconced in it, you're already too late. You can catch up, but there's too much going on within the AI world that somebody told me one time. They said, AI is never going to take the job of someone who knows how to manage AI. So given that, I would imagine that, and from personal experience, understanding the power of AI and how to strategically use it is critical.
Give me the book you've recommended or gifted the most in the last year.
And Then Everything Changed by Jeff Greenfield. It is a hypothetical history, and it is so interesting. And most of us don't realize that at all points in history, very, very big outcomes are sometimes funneled into a single decision or a single event or something along those lines. This book explores what would have happened had those decisions gone the other way. One of my favorites is that there was an assassination attempt on Kennedy right after he was elected. Somebody drove up in a car full of explosives, but because he was with Jackie, the man decided not to do it, and they ended up catching him. But had he succeeded, Kennedy would have been assassinated after the election, but prior to the Electoral College voting, which would have created a constitutional crisis because it wouldn't necessarily have fallen back to Johnson, and then the Cuban Missile Crisis and so on and so forth. And I didn't mean to go off on that tangent. I just find it fascinating that our world history at times are so focused into single moments that we may or may not even realize.
It sounds like an interesting read for sure. Give me a daily habit that helps you stay focused on your goals.
Well, I manage stress by working out quite a bit, and if you're not doing that, it's just a fabulous way um, to kind of keep focus on making yourself physically and mentally and emotionally uh, more balanced. So I definitely recommend hitting the gym a few times a week.
Give us your number one insight for, and I'm going to say, investing with purpose.
It means different things to different people. Investing with purpose to me has a couple of meanings. Number one is to ensure that the money that I'm putting away today, I can expect to have a return, an attractive return down the road. But with purpose now also has different meanings. If you invest in a company on Wall Street, for example, you don't know where your money is going. It could be going towards building a new factory, which is great. It could be going towards settling a sexual harassment lawsuit, also not great. With today's environment and the ability to tap into Reg A and Reg D and other alternative investments, investing with purpose now means that I can align my investment with what I believe is important, what aligns to my values. And that's one of the reasons I chose to work with Worthy, because I know that over and above my return, there are people out there that are going to benefit from my investment. And it makes me feel good.
All right, we're going to change the mood up here a little bit. Give us your favorite place to grab a bite to eat.
Stone and Tap is this little outfit just north of Atlanta that serves really, really good hamburgers and cold beer. And it's a great place to watch a football game.
There you go. Stone and Tap it is. Well, David, great stuff, man. You talked about investing with purpose and really democratizing investments where folks can get in for $100, $10, but really just have more access to investments, particularly those folks who are maybe blocked out by more traditional mediums, right? Don't have a 401k, you work in the gig economy. Here's another way to invest. So I love the fact that this is more attainable for other people to learn how to invest in alternative assets like real estate without necessarily having to be operators themselves or jump through other, qualification hoops. For folks that want to learn more, worthywealth.com is the website. We'll put a link to that in the show notes. I want to thank you again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
Likewise. Thanks.